Welcome to Talk Tickers. So usually this is where we'd be, digging into quarterly results, guidance updates, all that EBITDA stuff. But today we're doing something a little different. We are sort of stepping back from the script and looking at the machinery under the market itself.
That's right. Today isn't about one company's performance or if they missed revenue by 1%. It's about a phenomenon that's, it's rewriting the rules of how companies survive distress.
And maybe more importantly, how lenders survive each other.
Exactly.
We are talking about a trend that honestly sounds less like high finance and more like a gladiatorial match.
Right.
The term for it is creditor-on-creditor violence.
It is a very dramatic term, but it's entirely accurate. If you talk to lawyers and bankers, they'll use a softer term, a euphemism, liability management exercises. LMEs.
Right.
But make no mistake, violence is really the right word for what's happening on the ground.
So I want to set the scene for you here.
Sure.
Imagine you lend money to a friend. You've got a contract, a promise to be paid back. And then that friend gets together with a few other friends. They change the rules without telling you, and then they use your own money to pay themselves first. You're left with nothing. Is that basically what's happening?
That is a terrifyingly accurate analogy. We're looking at a world where distressed companies, usually backed by very aggressive private equity sponsors, are conspiring with just a select group of their lenders.
Okay.
And they're restructuring debt not to help everyone, but to aggressively disadvantage or prime the other lenders in the exact same company.
So it's a civil war.
It's a zero-sum game, a fixed stack of debt, and some creditors are conspiring to cut the line. They jump to the front, push everyone else back. The winners get, say, 100 cents on the dollar.
And the losers.
The losers get left holding a bag that might be worth pennies. And the kicker? All of this is happening outside of bankruptcy court.
That's the wild part. No judge, no jury, just execution. But why now? I mean, was finance always this ruthless?
It's always been competitive, but the ferocity we're seeing it's new. It's really the collision of two massive pressures. First, the macro environment. High interest rates are pushing companies to the brink.
Desperate times.
Exactly. Desperate measures. But the second factor is structural. We are living in the era of the covenant-light loan.
I hear that term all the time. Cov-light. What does that actually mean?
So go back 20, 30 years. A bank lends you money. The contract had maintenance covenants, strict guardrails. You had to maintain a certain debt ratio every single quarter. If you tripped it,
the bank's on your doorstep.
Immediately, like a strict parent with a curfew. You miss it by 1 minute, you're grounded.
Okay.
But over the last decade, investors got desperate for yield and gave up those protections. Now, something like 90% of the leveraged loan market is covenant light.
And what does that mean in practice?
No quarterly checks. They have incurrence covenants, which only kick in if you try to do something specific, like take on new debt. The strict parent has been replaced by a parent who's away on vacation and just says, don't burn the house down.
So the documents are loose.
Incredibly loose. And when the documents are loose, the lawyers get creative. They start looking for loopholes or trap doors that let them do things that were impossible a decade ago.
Okay, so let's unpack this. We've got desperate companies, loose contracts. That's a bad combination. I know you mentioned two main ways this violence plays out, drop downs and up tiers.
Those are the two big weapons in the arsenal.
Let's start with the drop down. Sounds like a wrestling move.
It is a wrestling move, but against your lenders. And to really get it, you have to go back to 2016 to the retail giant J. Crew.
Oh, J. Crew. Yeah, I didn't picture them as financial revolutionaries.
They were patient zero for this maneuver. Right. So J. Crew was in trouble, mountain of debt. But they had one very valuable asset, their brand, the IP, the name itself.
All right. And usually if I lend you money, that brand is my collateral. If you go bust, I own the logo.
In a normal world, yes. But J. Crew's lawyers found a loophole. The contract had these things called baskets allowances that let them move small amounts of assets around.
For like administrative reasons?
Exactly. But they figured out if they used these baskets in a very specific way, they could transfer the IP out of the main company.
Transfer it, right.
Into a new subsidiary. And here's the crucial part. This new subsidiary was unrestricted.
Unrestricted. Okay, explain that to me like I'm 5.
Imagine the company is a fenced-in yard. Inside the yard, the lenders are safe, their collateral's there. An unrestricted subsidiary is the neighbor's yard. The rules of the credit agreement, all those promises, they don't apply in the neighbor's yard.
So J. Crew took the brand, the most valuable thing they owned, threw it over the fence into the neighbor's yard and said, hey, this isn't covered by our agreement anymore.
That's essentially what happened. And once the IP was in that unrestricted sub, it was free and clear. So J.Crew went out and borrowed new money from new lenders using that IP as collateral.
And the original lenders?
They woke up and their collateral was just gone. They were left with a claim on a company that didn't even own its own name anymore. The value was stripped out or dropped down.
That's wild. The market must have lost its mind.
It was absolute chaos. People were screaming fraud, lawsuits were flying, but the courts looked at the contract and said, technically, the text allows it.
Wow.
And once the market saw that it worked, the floodgates just opened.
So J.Crew was just the start.
It evolved so rapidly. You saw companies like Envision Healthcare take the J.Crew model and just put it on steroids.
How do you put a loophole on steroids?
Well, J.Crew used one trap door. Envision used a tactic called basket stacking.
Sounds like a sport.
It practically is. Most contracts have different baskets or allowances, right? A basket for dividends, one for investments, another for admin costs. Envision's lawyers said, what if we use all of them at once?
You're kidding?
Nope. They combined multiple unrelated allowances to move a huge profitable chunk of their business, their ambulance division, away from the lenders.
So they basically scraped together the spare change from under all the couch cushions and suddenly had enough to move $1 billion asset.
That's a perfect way to put it. And then you get cases like Pluralsight, which got even more technical. They moved assets to a subsidiary that was restricted but wasn't a loan party.
My head is spinning just from the legal gymnastics.
It's designed to be confusing. The complexity is the whole point. For Pluralsight, that move meant the new entity wasn't on the hook for the old debt. It was a clean slate to raise new cash. Now, it didn't save them in the end, but it shows the length sponsors will go to.
They will find any crack in the wall. So that's the drop down. But what about the other tactic, the up tier? That sounds even more aggressive.
The up tier is where the Civil War really gets ugly. The industry calls it priming. If the drop down is hiding the furniture, the up tier is changing the locks on the front door so your roommates can't get back in.
Okay, give us the headline example.
The most infamous case by far is Serta Simmons betting, back in 2020.
The mattress company.
Right.
I remember this making huge waves. What exactly did they do?
So Surda was drowning in debt. They needed cash. They went to a group of their existing lenders. Let's call them the majority group. These guys held just over 50% of the debt. And Surda offered them a deal. Give us new cash, and we'll let you jump the line.
Jump the line how?
They created a whole new class of super priority debt, and they allowed this majority group to exchange their old regular debt for this new super priority debt.
So they swapped their old ticket for a VIP golden ticket. What about the other lenders, the ones who weren't in the room?
They get crushed. The minority group, the other 49%, they weren't invited to the party. So they were left holding the old debt, which was now subordinated. That means in a bankruptcy, the majority group gets paid first, second, and third. The minority gets whatever scraps are left over.
So their investment effectively goes to zero.
Overnight. Their paper was trading near par one day and at pennies the next.
How on earth is that legal?
Yeah.
Don't these contracts have rules to prevent exactly that? Like pro rata, everyone gets treated the same.
You would think so. Usually changing the repayment order requires 100% of lenders to agree. It's a sacred right. But Surda found a loophole that is just. It's breathtaking. They use a clause about open market purchases.
Open market purchases. I feel like we're going to be talking about those three words a lot.
The contract said the company could buy back its own debt on the open market without triggering those sharing rules. Surda argued that this private backroom deal with the majority group was technically an open market purchase.
Even though it was a secret deal that excluded half the lenders.
That was the argument. Hey, we're buying the debt back. It's a transaction, therefore it's allowed.
That is stretching the definition of open. But this created a really nasty dynamic. It wasn't just the company versus the bank anymore.
Yeah, it turned into lender versus lender, a real prisoner's dilemma. You had these massive hedge funds and PE shops conspiring against smaller holders. If you're managing a CLO, a collateralized loan obligation, you're just helpless while the big sharks eat your lunch.
It's paranoid. You either join the kill squad or you get killed.
That's exactly the vibe. In the Revlon case, it got even crazier. To get to that 50% voting threshold, they actually had to manufacture votes.
Manufacture votes, like ballot stuffing.
In a financial sense, yeah. They created sham revolving lines of credit. These were loan commitments that were never really meant to be used. They just existed on paper to give certain friendly lenders more voting power so they could force the deal through.
That is so dark. We're talking manipulation, secret deals, vote rigging. It just feels like theft. But, and here's where my brain starts to hurt. You're telling me there's an economic theory that says this might actually be a good thing.
I know, it sounds completely insane, but there's a school of thought that suggests this kind of violence, it actually creates efficiency.
How can robbing your creditors possibly be efficient?
Well, you have to look at the alternative, which is a company drowning in what we call debt overhang. If that company files for Chapter 11 bankruptcy, it's a disaster.
Right. Lawyers cost millions, the brand takes a hit, customers run away, it's a mess.
Economists call those deadweight costs. Value is literally destroyed by the bankruptcy process itself. So what you want, ideally, is a way to reduce debt without going to court.
Okay, follow that. Avoid the courtroom.
The theory is that these up-tier deals act as state contingent debt reduction.
That is a mouthful. Break that down.
State contingent just means it only happens in a specific state of the world, the bad state, where the company is failing. Lenders would only agree to these aggressive swaps when the company is in deep trouble. So the threat of an up-tier acts as a release valve.
So it wipes out debt and keeps the company alive, all without needing a judge.
Exactly. It transfers value from the minority lenders to the company and the participating lenders. It keeps the business going.
But isn't there a cost? I mean, if I know I might get primed, aren't I going to charge more to lend money in the first place?
You've hit it right on the head. Lenders aren't stupid. They know this risk exists now. So yes, they charge higher interest rates, higher credit spreads upfront to compensate.
So borrowing costs go up for everyone.
They do, but the economic model suggests that even with those higher costs, the value saved by avoiding bankruptcy is greater. There's a net surplus and firm value.
So it's ruthless, but mathematically optimized.
It's in theory, but try telling that to the lender who just lost 90% of their investment.
Right. Sorry I took your money, but it was for the greater good. That doesn't hold up in a bar fight. But it held up in court for a long time. Why did judges let this happen?
This brings us to a legal philosophy called debt textualism.
Debt textualism. It sounds like a religion.
In the world of New York law, it basically is. For the last 50 years, courts have taken a very hard line. They view these lenders, these huge funds and banks, as sophisticated parties.
Meaning they're big boys who should have read the fine print.
Exactly. The courts basically said, we are not here to baby you. If it's not written in the four corners of the document, it doesn't exist. If the contract didn't explicitly forbid a drop-down, then they assumed you could do it.
What about fairness? The implied duty of good faith?
In consumer law, sure. But in corporate debt, that duty was largely ignored. The court said, you want fairness? Write it into the contract. If you left a loophole for an open market purchase and you didn't define open market, that was your problem.
So the courts are basically saying, write a better contract next time.
And that is exactly what lenders started doing. They realized the courts weren't going to save them, so they started building their own defenses. We call them blockers.
This is the Empire Strikes Back moment.
It is. Lenders started demanding very specific clauses. Now you see J.Crew blockers in almost every deal, specifically banning the transfer of material IP.
Closing the trapdoor.
Then you get Serta blockers. These clauses require all lenders, 100%, to approve any subordination of liens. That kills the up-tier debt.
I've also heard of Chewy blockers from the pet food company.
It is. Chewy had an issue where a guarantee fell away because a subsidiary was no longer wholly owned. So now lenders demand a blocker that prevents that.
So the contracts are getting tighter. But the biggest plot twist wasn't from the lawyers. It came from the courts, right?
This is the news that has everyone scrambling. For years, the Surda case was the gold standard for it's nasty, but it's legal. But on December 31st, 2024, New Year's Eve, the Fifth Circuit Court of Appeals dropped a bombshell.
They reversed the lower courts.
Completely reversed it. The Fifth Circuit ruled that the Surda up-tier was, in fact, illegal.
Wow. So after all those years of read the fine print, a court finally stepped in. Why?
Well, not because of fairness. They actually beat the textualists at their own game. They looked at that magic phrase, open market purchase.
The loophole.
The loophole. The court literally pulled out the dictionary. They asked, what does open market actually mean?
Yeah.
They ruled that an open market must be a market where price is set by competitive bidding, and crucially, it must be open to all comers.
And the Surda deal was a secret handshake behind closed doors.
Exactly. The court said you cannot call a private invite-only transaction an open market purchase. It violates the plain meaning of the English language.
So because they excluded the minority, it wasn't open, so the exception didn't apply, so they needed 100% approval.
Bingo. And because they didn't get it, the whole thing was a breach of contract.
This has to be a shockwave for the industry. Billions of dollars have been restructured using this exact logic.
It's a massive earthquake. It suggests debt textualism has its limits. You can't just twist words to mean whatever you want. If you say open market, it actually has to be open.
So if I'm a PE sponsor sitting on a deal that relied on that Surda precedent, am I in trouble?
You are sweating. We're going to see a flood of new litigation. Deals that everyone thought were done might get reopened. It changes the whole risk calculus.
So where does this leave us? The courts closed one loophole. Lenders are writing blockers for others. Is the war over?
The war is never over. It just moves to a new battlefield. As long as you have distressed companies and these loose Cov-Lite documents, the incentive to find the next loophole is just huge.
So what's the next frontier? If you can't drop down or up tier, what do you do?
We're already seeing it. It's called the double dip.
The double dip. Sounds like something you do at a party.
In finance, it's way more lucrative. Here's how it works. A lender provides a new loan to a subsidiary of the company, but they also get a guarantee from the parent company.
Okay, so lending to the child, but the parent co-signs.
Right. But because of the corporate structure, this gives that one lender two separate claims on the same assets, a claim against the sub and a claim against the parent.
They get to double count their debt.
Effectively, yes. In a bankruptcy, they can recover from both entities, which dilutes the recovery for everybody else. It's a way to manufacture seniority without technically priming anyone in the way Surda did.
It's an arms race. Lenders build a 10-foot wall, borrowers build an 11-foot ladder.
And the lawyers get rich building both.
So what does all this mean? We've covered a ton of ground. Drop downs, up tiers, the economic theory, the legal smackdown.
It's a masterclass in incentives. But I want to leave you with one final thought. We generally think lender protection is a good thing. We cheer when the court stops the theft in the Surda case.
Of course. Fair play.
But go back to that economic theory, the idea that these ugly maneuvers actually save companies from the deadweight costs of bankruptcy.
The paradigm.
If we make contracts ironclad, if we use blockers and court rulings to make it impossible to restructure debt without 100% consensus, are we actually hurting the economy?
You mean if we lock the doors so tight no one can steal? We also lock them so tight no one can escape the fire?
Precisely. If we protect lenders so well that the only option left for a struggling company is a chaotic, value-destroying Chapter 11 filing, have we really won? Or have we just made sure that when companies fail, they fail spectacularly?
That is a fascinating and slightly disturbing place to stop. We will be watching the fallout from the Surda ruling very closely. Thanks for listening to Talk Tickers.